There is a ticking time bomb buried deep beneath the foundation of the Canadian economy. It's not made of explosives. It's made of paper, contracts, and hasty signatures. For the last 5 years, Canadians have been living in a strange dream. A dream where money was cheap and home values would only ever go up. But the laws of the universe and the laws of economics always demand balance. Every party must end, and the bill is finally coming due. Welcome to the milestone that every financial expert on Bay Street is fearing. The year 2026. Why 2026? Why not last year? Or the year after? Because in 2026, approximately $900 billion worth of Canadian mortgages are coming up for renewal. Those who borrowed to buy homes at the peak of the 2021 frenzy, with rates near zero, are about to wake up to a very different world. They aren't just facing a few $100s in extra costs. They are facing a payment shock that could eat up 50 or 60% of their monthly income. This isn't just an economic issue anymore, it is a survival issue. Today, we are going to rewind the clock to understand how Canada walked into this trap, compare it to the devastation of 1981, and most importantly, how you can survive the wall of 2026. To understand the tragedy of 2020, we have to return to the scene of the crime, 2020 and 2021. The pandemic was raging. The world shut down. To save the economy from collapsing, the Bank of Canada slashed interest rates to historic lows, 0.25%. The message was clear. Go borrow, go spend, we've got your back. And Canadians listened. Oh, did they listen? Let's look at a character named Alex. Alex represents the Canadian middle class. In 2021, Alex bought a home worth $1 million and took out an $800,000 mortgage. Back then, the 5-year fixed rate was 1.7%. Alex's monthly payment was around $3,200. For Alex and his partner, this was manageable. They had stable jobs, cheap debt, and life was good. They signed a 5-year term. Why 5 years? This is the fatal difference between Canada and the US. In the US, you can lock in your rate for 30 years. You are safe for life. But in Canada, the most common term is just 5 years. After 5 years, you are at the mercy of the market. This means Alex didn't really own that 1.7% rate. He was just renting it for 5 years. And that lease expires in 2026. Now, fast forward to 2026. Inflation has ravaged the economy. The central bank hiked rates to control prices. Mortgage rates are no longer 1.7%. They are hovering around 4.5% to 5.5%, even in the best-case scenario. What happens to Alex? The $800,000 debt is still there. But upon renewal, his monthly payment jumps from $3,200 to $5,100. That is an increase of nearly $2,000 a month. That is $24,000 a year. After tax, think about that. $24,000 in net cash. To get that kind of money, Alex needs to earn an extra $35,000 to $40,000 in gross income. How can he do that in a stagnant economy? He can't. And Alex isn't alone. There are about 2.2 million Canadian families in this same sinking boat between 2025 and 2026. This is the trap. A generation of Canadians was seduced into debt at impossible prices, only to be locked into an interest rate cage with no key. Many people will say, "Oh, don't be so pessimistic. We've survived much higher rates. Just look at 1981. True. Let's look at 1981. It was the darkest time in Canada's modern financial history. Inflation was skyrocketing. Mortgage rates hit 21%. You heard that right. 21%. People back then were so desperate they coined a new term: jingle mail. This was when homeowners put their keys in an envelope and mailed them back to the bank, walking away from everything. The sound of keys jingling in the mail carrier's bag was the sound of collapse. But there is a truth that optimists often forget when comparing today to 1981. Yes, rates were 21%, 4 times higher than today. But look at the home prices. In 1981, the average Canadian home cost about $70,000. The average household income was $25,000. The price-to-income ratio was only about 3 to 1. And today, that ratio is 10 or even 12 in cities like Toronto or Vancouver. This leads to a terrifying paradox. A 5% interest rate today hurts much more than a 21% rate did in 1981. Why? Because the principal debt today is massive. 5% on $1 million is a killer compared to 21% on $70,000. We are more indebted than any generation in the history of this country. And that is why 2026 might not see mass jingle mail, but it will see something worse: the silent depression. What happens when millions of households like Alex's suddenly lose $2,000 of purchasing power every month? They don't starve. They keep paying the mortgage. In Canada, the culture and the laws make foreclosure very difficult compared to the US. Banks will pursue you to the end, and Canadians would rather skip meals than lose their homes. And that is exactly the problem. The money to pay the bank has to come from somewhere. It comes from the real economy. In 2026, we will see the rise of the zombie consumer. They still work, they still have a house, but they aren't really living. They don't buy new cars. The auto industry suffers. They don't eat out. Restaurants collapse. They don't travel. Tourism freezes. This is the domino effect. When disposable income is sucked into the banks to service debt, small businesses are the first to fall. And we haven't even talked about investors. In Toronto and Vancouver, over 50% of new condos are owned by investors. But with the new rates of 2026, their cash flow will turn deeply negative. Rent won't cover the mortgage. What will they do? Sell. 2026 could see an unprecedented sell-off in the condo market, driving prices down and dragging everyone's net worth with it. When you feel poorer, you spend less. And the downward spiral continues. The picture I've painted is bleak. But the purpose of this video isn't to scare you, it's to prepare you. If you or your family have a mortgage renewing in 2026, you need to act now. Don't wait for the bank's letter to arrive at your door. Here are 3 strategies to survive the wall. Strategy number 1: the preemptive strike. If you have savings, consider making a lump sum payment on your principal now before renewal. Most Canadian banks allow you to prepay 10 to 15% annually. Reducing the principal means reducing the interest you'll pay when rates go up. This is a guaranteed 5 or 6% return on your money, tax-free. Strategy number 2: extend the pain. Upon renewal, ask your lender about extending your amortization period back to 25 or 30 years. For example, if you've paid for 5 years and have 20 left, ask to reset it to 25. This will lower your monthly payment, giving you breathing room. The cost? You will be in debt longer and pay more total interest. But in a storm, the goal is to keep the ship afloat, not to go fast. Strategy number 3: shop around. Canadians have a lazy habit of just signing the renewal letter the bank sends them. Don't do that. In 2026, banks will be fighting for good clients. Take your business to other banks or to credit unions. A difference of 0.1 or 0.2% over the next 5 years could be worth the price of a new car. 2026 is going to be a tough year. It will be a stress test for an entire generation of Canadians who got used to the comfort of cheap money. But economic history teaches us one thing: humans are incredibly adaptable. We survived the inflation of the 70s, the rates of the 80s, the dot-com bubble, and the 2008 crisis. We will survive 2026 too. However, the world on the other side of the wall will be different. It will be a world where the value of a dollar is respected again. A world where saving and risk management aren't just cliches, but survival skills. The dream of getting rich quick from real estate might be dead, but the dream of sustainable financial security is still in your hands if you prepare today. Thanks for watching. If you found this video helpful, share it with anyone who owns a home in Canada. They need to know what's coming. Don't forget to subscribe for more analysis on money and history. I'll see you in the next one.